Here on The Quality Investor, we only deal with top-rate businesses. And one of the absolute best just released their Q4 2024 earnings. And again, this business posted strong growth in the areas that matter most: revenue and free cash flow. Yet, this remarkably stable and growing business had an annoying little sell-off in the market. So, with a good 2025 outlook, why this market irrationality for indexing giant MSCI? Welcome to The Quality Investor. This earnings report was by no means an extraordinary event worthy of a 10% plus pop in the market. However, it did underscore the strength of MSCI's business model yet again. There was nothing that should sound alarm bells for investors to panic sell. And while the sell-off isn't large, just under 6% at close, it is not based in anything concrete in my view. Remember though, markets are forward-looking. So something spooked the market just enough to drive the share price down. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. My conjecture is Wall Street expectations versus reality. My personal opinion on Wall Street expectations are they should be taken with a rather large grain of salt. In other words, they are divorced from the fundamentals of the actual business. Yet the market loves Wall Street expectations. I do not believe they are altogether useless. I think they can provide anchoring and growth assumptions, but they should in no way affect the movement of a stock price. But that won't change anytime soon, and it appears this affected MSCI's drop today. I will dive into the beats and misses in MSCI versus expectations, review the earnings report, assess their outlook, and finally, provide what I believe is the appropriate buy price for this wonderful business. Is it still at a premium after today's earnings? Let's find out. I believe the reason for the price drop for MSCI was due to their performance against Wall Street estimates. So we're looking at the article here, MSCI Q4 earnings, how key metrics compare to Wall Street estimates. MSCI reported $743.51 million in revenue for the quarter ended December 2024, representing a year-over-year increase of 7.7%. Earnings per share of $4.18 for the same period compared to $3.68 a year ago. The reported revenue compares to a consensus estimate of $744.46 million, a slight miss on revenue by about 0.13%. The company delivered a EPS surprise of 5.5%, with the consensus EPS estimate being $3.96 per share. So right off, a bit of a mixed bag. Top line miss, but bottom line beat. I think it becomes a little bit clearer when you dig into the specific estimates, however. To me, the biggest one is this: period end AUM and ETS linked with MSCI equity indexes. This only increased by $1.72 billion, but they estimated a $1.75 billion increase. This is one of MSCI's main moneymakers. They collect a small asset fee based on assets under management, or AUM. The index run rate, the recurring subscriptions, another main source of their revenue, $935.25 million compared to $931.58. Total run rate, $2.24 billion versus $2.27 billion. For subscription-based businesses, run rate is an important metric. And if that's coming in under what analysts are expecting, the stocks tend to get hit for missing that. And just looking at the operating revenues per segment here, you can see ESG and climate, 85.22 versus 85.27, so a slight miss there. Asset-based fees increased, however, $175.34 million to estimates of $170.59 million, but then operating revenues for the analytics down a bit, $172.75 million versus $174.53 million. And while the index segment as a whole did pretty well, operating revenues of $420.20 million versus $416.51 million estimate, we can see the recurring subscriptions portion of that was at 228.44 million versus the estimate of 229.4 million. So a bit of a mixed bag when it comes to MSCI and beating their estimates when you break it down to the segment level. But overall, they miss on some of the more important ones, like run rate, like AUM. And I think that was the overall concern in the market for MSCI's fall. This is a high-level summary of the operating statement for MSCI. And you can see some other things that might be a bit of a cause for alarm in the numbers. While overall revenues did grow by nearly 13% year over year, operating margin is actually down. It was 54.8% last year versus 53.5% this year. However, on a quarter-end basis for December 31st, 2024 only, we do see the operating margin getting back to an increasing point, 54.5 for the quarter versus 53.7 for the quarter last year. So it's trending in the right direction. We just want to see them continue to increase that operating margin. There's some other troubling things in here as well. You can see the run rate and retention rate. Specifically on the retention rate, in the fourth quarter of this year is at 93.1%, which is compared to 93.6% last year. A slight drop there. And looking at the income statement as a whole, it does appear the reason for the big squeeze in margins for the year is this amortization of intangible assets. You can see it popped by 43% year over year on the whole year. Is at 164 million on the year versus 114 million last year. Fairly large increase, but this is due primarily to the acquisitions that they have been making. Once you acquire another business, you have to amortize the goodwill of that business, or otherwise known as the premium you paid for that business, over time. And of course, if you make a lot of acquisitions, that amortization expense of intangible assets will increase, and that is the primary reason MSCI went on a bit of a buying spree in 2023. You can also see net income actually decreased by 3%, but there's another one-time expense aiding net income in 2023. That is this gain on the remeasurement of equity method investment, which aided in a 143 million gain last year. So that one-time gain wasn't there in 2024, which resulted in this small loss. At the end of the day, what we care about with our investments, though, is how much money is going to be in the investor's pocket every single year. And in that instance, MSCI excelled yet again. MSCI posted operating cash on the year of 1.5 billion. They have two line items of capitalized costs. You have capitalized software development costs and capital expenditures. You have to deduct both of those out of the operating cash to get the MSCI's free cash flow. You can see the capitalized software was 81.356 million. Actually a pretty decent jump there from 68 million in the prior year. And CapEx was at 33.762 million. But these are tiny numbers compared to the 1.5 billion in operating cash. This results in free cash flow for MSCI at $1.386 billion, compared to free cash flow at 2023 of $1.145 billion. That's a 21% increase in free cash flow year over year. They're bringing in more free cash flow than they are net income. And therein lies why MSCI trades at the premium it does. It is a free cash flow machine, and that free cash flow has done nothing but increase over time. As for the outlook, MSCI doesn't actually provide an outlook for revenues, but deducing from what they do provide an outlook for operating expense, CapEx, net cash provided by operating activities, and free cash flow, combine that with analyst estimates, you can expect revenue to increase just under 9% in 2025. And based on the operating expense here, the operating margin will probably be about the same as it was in 2024. So I have it estimated at 53.5%. And ultimately, they're projecting only slight free cash flow growth, only about 1 to 5% based on this range here. So given this outlook, is MSCI still trading at a premium valuation? We'll start with the middle chart here, which is revenue segment growth. And on the base case, I have the index subscriptions growing about 8.6%. Asset fees at 8%, and non-recurring growing at 8%, all this over the next 10 years. You can compare that with the 5-year CAGR, 10.69, 12.5, and 4.95 for the same respectively. That gives us total index segment growth of 8.4%. Analytics I have growing at about 5%, and ESG and climate The most optimistic segment in MSCI's business right now, growing at nearly 14% over the next 10 years. MSCI's own estimates have their long-term growth pegged to nearly 20% for ESG and climate. I'm not quite as optimistic, and you'll see that here in a bull case in a second. Private assets grow at about 8.58% over the next 10 years. It gives us total revenue growth on the base case at about 8.5% over the next 10 years. But like I said, you can see the ESG climate on the bull case I have growing about 10.5%. And that's because I'm actually more optimistic about their index segment than the ESG and climate segment. I can envision a world where less emphasis is placed on the ESG segment and investors putting capital there, in a world where far more investors put their capital, especially worldwide, into index funds, which is the current trends right now. I've done multiple videos about this on MSCI. I will link them below. In that case, then, I had the index bull case growth there at about 12.78%, analytics at 7.3%, 10.5% for ESG, and 10.78% for private assets. That's 11% revenue growth on the bull case the next 10 years in MSCI. Bear case, you can see the numbers here. I have just under 7% revenue growth on the bear case. Total revenue growth the last 5 years has been at 12.85%. So my estimates here are well under what MSCI has done historically. I told you I was using a 53.5% operating margin. I split the difference on their estimated income tax, so about 18.75%. And free cash flow conversion, a little bit lower than last year's. Free cash flow conversion for 2024 is at $1.25. I have it at $1.17, given the slower growth they expect in 2025 for free cash flow. They repurchased about 1.5% of their shares in 2024. I have that in year one at about 1.25%. And I expect the dividend to grow from $6.40 to $7.20, which would be at about 12.5% growth. They are actually an excellent dividend company. You can see the 5-year dividend growth average here is over 20%. And when they popped their dividend to $6.40, that was a 20% year-over-year dividend increase. I have their bull case dividend growing at about 16%, 14% on the base, and 12% on the bear case. On a perpetual basis, these numbers could be a lot higher in my opinion, but 7% for the bull case, 6.875% for the base, and 6.75% for the bear case. Their free cash flow payout percent for dividends right now is under 40%. And I could see massive dividend growth out of MSCI going forward. So I think I'm being conservative with these dividend numbers. So looking at the final estimates at year 10 for revenue, like I said, is at just under 7% on the bear case, 8.5% on the base, and 11.24% on the bull. Operating income, I expect it to grow about just over 7% of the bear, 9% on the base, and 12.3% on the bull case. I do estimate operating margin to be about 57% by year 10 on the base case, going up to 59% if they do well and hit the bull case. And ultimately that gives us free cash flow growth over the next 10 years at 8.65% for the base case and just over 12% for the bull case. On a base case, I have the free cash flow margin at year 10 being at 49%, which would be just over what the free cash flow margin is today at 48.55%. You can see that free cash flow did grow at about 21% year over year. So these free cash flow numbers are certainly not out of the realm of possibility. If they do well, they hit their growth numbers, free cash flow margin above 50% is certainly possible. MSCI closed Wednesday at $593.05. That is a PE ratio of 42.2, slightly above their 10-year average, but under their 5-year average of 51. Their forward PE is at 38.4, which is right in the middle of their 5 and 10-year average. My DCF for the bear case is at $415.90, $513.76 on the base, and almost $700 on the bull case. I said before the dividend is an excellent dividend. The bear case in the dividend discount model is at $645.60, $765.25 on the base, and $917.69 on the bull case. Their exit multiple comes in at $598.02 using comps of S&P Global, Moody's, and Intercontinental Exchange. So given that right now, the bear case valuation averages at $518.85, $597.70 for the base, and $728.66 for the bull case. So it looks like at $593.05, MSCI is priced right about where it should be in the market. There is some potential for upside, assuming they hit their bull case growth numbers, but they're going to have to really outperform what they've been estimating over the next few years. There is that upside there of almost 23%, and if they severely underperform, we could expect the stock to decrease quite a bit. So without any margin of safety, it's a buy price of $610.73. With a 10% margin of safety, it's a buy price of $549.65. And at a 20% margin of safety, it is a buy price of $488.58. MSCI has shown to be volatile in the last couple years, so it wouldn't surprise me at all that one bad earnings report and we could see MSCI slide back down under $500. And I do think for me to add more, I would have to see it go back under $500. As much as I like this stock and I have a very large position in MSCI, I do think it's trading at a premium right now, and it's something I would definitely not add to anytime soon. I believe it will continue growing very well into the future, and I have no plans of selling it. But like I said, I'd want it to come down under $500 before I would be willing to buy more. All in all, MSCI has an excellent business model, excellent growth prospects, excellent dividend growth prospects, and is a very good business all around to hold in your portfolio. When it comes back down again, I'll certainly add more, but in the meantime, I'm perfectly happy simply holding the stock in my portfolio. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.